Now we can go back to the example of writing off an individual customer. So we see here that we have that same example. January 23rd, we've determined that their $520 account is uncollectible. Instead of just writing it off as a bad debt, we're going to record it into our allowance for doubtful accounts. So we are going to debit allowance for doubtful accounts and credit accounts receivable. That write-off does not affect the realizable value of accounts receivable, as we can see here. So before the write-off, the realizable value of accounts receivable was $18,500, and after the write-off, our realizable value is exactly the same. If then our customer pays us at a later time, we have to reverse the transaction that wrote off the account receivable. So we need to restore the account receivable on the books and then record that we received cash for that account receivable. We can estimate those uncollectible based on sales and our accounts receivable. So we have different methods of what that estimate looks like. So we have two methods. One is the percent of sales method, and the other is the accounts receivable method. Under the accounts receivable method, then we have two different methods. First, we're going to look at the percent of sales method. Under the percent of sales method, our bad debt expense is computed as a percentage of that period's sales. So in this example, we estimate that 0.6% of credit sales are eventually uncollectible. So if we have credit sales of $400,000, we take that $400,000 times 0.6% and get a bad debts expense of $2,400. So we have bad debt expense of $2,400 and our allowance for doubtful accounts for $2,400. If we're using the percent of receivables method, then we have the year-end accounts receivable times our bad debt percentage. Our bad debt expense is computed as then the total estimated bad debts expense minus the previous balance in the allowance account, and that gives us our current bad debts expense. So under the percent of receivables method, we have said that 5% of receivables are uncollectible. So we have, at the beginning of the year, we have a $200 credit balance in allowance for doubtful accounts, and we estimate that 5% of receivables are uncollectible. Our accounts receivable is $50,000. So we have $50,000 times 5% equals $2,500 ending balance. We want that ending balance in there. So instead of our bad debts expense being $2,500, our bad debt expense is whatever it takes to get the balance to the allowance for doubtful accounts to $2,500. The next method that we look at is called aging of receivables method. So the aging of receivables method shows that as a receivable gets older, the chances of it being collected become more and more unlikely. So we have age groups for our bad debts. Let's look at an example. So we have new receivables that just happened in this month, receivables that are anywhere from 1 to 30 days past due, 31 to 60 days past due, and 61 to 90 days past due, and over 90 days past due. Then we have a bad debts percent for each group. So we have a idea of what is estimated uncollectible based on how overdue it is. So you'll see that anything that's over 90 days due, we have a higher idea that we're never going to collect that fund. So we have a 40% bad debts estimation for anything over 90 days due. So we separate out our total accounts receivable into separate amounts based on the number of days it is past due, and then take it times the percentage and add it all together. Here we have an estimated uncollectible amount then of $2,270. Our journal entry is the same. It is whatever our journal entry needs to be to bring our balance to $2,270. So that's an important thing to remember, that if we're using the percentage of sales, then our bad debts expense and allowance for doubtful account is whatever amount the percentage of sales is. If we're using either one of the accounts receivable methods, then our adjusting entry is for what we need the allowance for doubtful accounts to be. So these are our different methods. So we have the percentage of sales, which focuses on the income statement. So it's our sales times the rate equals our bad debts expense. Our adjusting entry amount is the percent of sales, bad debts expense. For the balance sheet focus, this is either percent of receivables or aging of receivables. When we use the balance sheet focus, then our adjusting entry is whatever it takes to get the total balance of the allowance for doubtful accounts to that total amount. The next thing that we're going to talk about is notes receivable. So when we have a note receivable, we record what is called a promissory note, which is a written promise to pay a specified amount of money with interest at a future date. So we have various information on this promissory note. We have who is going to pay us, how much it is, the due date, the date that it was made, if there's an interest amount. When we have this information, we need to compute the maturity date. So here it's a 90-day note. The note was written on July 10th. There are 31 days in July, and it was written on July 10th. So we have 21 days remaining in July. There are 31 days in August, 30 days in September, and then for a maturity date of October 8th, we would have 8 days remaining to equal 90 days. So our maturity date is October 8th. The interest computation is principal times rate times time equals the amount of interest. So the rate is annualized, it's our annual interest rate. So then we need to take it times time expressed in fraction of year. If the note's expressed in days, then the base in our calculation is going to be 360 days, which are the number of accounting days within a year. So here we have the principal is $1,000. The annual interest rate is 12%. It is a 90-day note divided by 360 days in our accounting year equals $100,000 or $1,000 times 12% times 0.25. So we have $30 in interest over the life of that note. Notes receivable are recorded in a single receivable account. So here we signed that note receivable on July 10th. This was in for sales, but we can have notes receivables for numerous things. So we record a notes receivable and then we have sales revenue. The seller can also accept a note receivable to cover their account receivable or allow an extension to pay a past due accounts receivable. So we have TechCom agreed to accept $232 in cash along with a $600 60-day note to settle a past due account. So she paid us partially in cash and then signed a note that she would pay us within 60 days at 15% interest to cover this past due account.